Hello, Baker Investment students. I'm Joe Barnhill. Will be with you for the next 7 weeks. So I want to say that I know that we have a small cohort. I think there's only 6, but I'm really looking forward to working with you all over that time period. I think you're going to really enjoy this course, and we're going to do some activities that are going to help solidify your understanding of investments and portfolio management. So just a little bit of overview. What I'll do is I'll post these every Sunday to give you an overview of the week, give you some insights, some things to think about. But today I'm going to give you a kind of quick overview of the syllabus, hopefully address some questions and give you some insights into your readings for chapters 1 and 2. So first with that, do make sure to read the syllabus, go through that completely. If you need to get a hold of me, email is the best bet, and I'll get back to you that day or the following day at the latest. If you do need to meet via Zoom one-on-one, just let me know. We can figure out a time and the logistics, and we can make that happen. But again, for this course, we're going to mostly look at how portfolios are designed, how investment decisions are made, about different markets, about different investment products, and some of the tools that are used in investing to help make better decisions. So of course, you have an online book, but here's the book that you should have: is The Fundamentals of Investing That Will Follow by Smart and Zuter. And of course, this week you'll read chapters 1 and 2. So what I want to do is go through some of the assignments for the course. First, with the homework, what I've done is I put some templates out there each week. The templates kind of give you some guidance and framework. What you're going to do is you're going to put in the formulas in those cells. So like equals A2 plus B2, whatever it is that you need to help you finish the problem. And of course, if you do have questions, do reach out to me earlier in the week as opposed to waiting till Sunday when they're due. I'll give you some guidance on that to help you solve the problems if you have questions. One of the fun things we're going to do in this class is the weekly portfolio project forum discussion. I put an example out there in week 1 where I picked about like 5 utility stocks. One of them is local average E. So what I'd like you to do this week, you want to pick a closing price. You can use the ones from this past Friday, and in fact that's what I would suggest. That's what I did. And think of it as that you have $1,000,000 and you're just tracking how did that change, each week. So it's kind of like you're sticking with this portfolio and you can't change it through the entire class is what I want you to think about this way. And do look at some of these stocks, see if any of them pay a dividend during this time period. So if they do pay a dividend, like you receive cash for the number of shares that you own, do include that, put it back in cash, or buy more shares of that same stock. So whatever you want to do in that particular week, if it does happen. But you may want to kind of, after you pick your stocks, like I'd say, a minimum of 5, but no more than 10. And you decide how you want to allocate amongst that $1,000,000. You can kind of play around with it, toggle back and forth in Excel to get yourself to that $1,000,000, or you can keep the leftover in cash, and then that's fine. But I think you'll find this interesting, and it will really give you something tangible to apply through the coming weeks to understand why did some of these stock prices change. Mostly it's going to be due to what we call company specific, but there can also be some systemic things going on, as we know, with the war with Russia, post-COVID, and all those things going on. The markets haven't done as well this past year, so they're kind of hanging in there, but definitely down from where we ended at the previous year. So you'll also have 2 main projects, 2 main papers. You have the investment manager style project. So this is where I want you to go out and maybe pick some famous investor. It doesn't necessarily have to be someone famous, but some of the famous ones I can think of, are Peter Lynch, Bill Ackman, Warren Buffett. A little bit better understanding of their investment philosophy and style, and why they chose the particular securities that they did or the particular strategies they did to help you learn about investing. And then, of course, the last one, the comment assessment, is going to ask you to look at some global event and how that systemically impacted the returns on markets. And as I mentioned most recently with the war in Russia, that obviously has had some impacts. You're seeing changes in interest rates because of concerns with inflation, but that could also be an event right now with the inflation. But there's been some things in the past like the subprime um, market disaster, but we really want to kind of focus on a little bit more recent events. So that's what we're going to do here. But again, it says what event happened, explain the events leading up to the event and why, and connect the concepts we have studied in the event. And think about COVID being the most recent one, in particular, that you can use as a topic, how it impacted market. But it's going to ask you to look and reflect on how it impacted stocks, how it impacted the return on bonds, mutual funds, and financial institutions. So that's a little bit of overview on the syllabus. But again, if you do have any questions, do reach out to me. Just some things that I want to point out for week one, relative to chapters 1 and 2, and you read about that. You're first going to read about the investment environment. Obviously going to look at the different types of securities. You're going to look at the difference between direct versus indirect. Debt, which we call fixed income, bonds that pay interest every 6 months, typically equity, which we refer to common stocks. And you're going to get into more like the general understanding of mutual funds, exchange traded funds, derivatives, which mean they derive their value from some other underlying security, such as, say, forward or a future or an option. And you're going to do a little bit of the overview of investment goals. One of the things that I want you to get out of this course is to understand why individuals make the decisions they do. Where are you in your life? The textbook pointing that out, from maybe 20 to 40 to 40 to 60. 60, when we typically think about going into retirement, the different strategies that people take to build up wealth over their lifetime, mostly through retirement funds, but there can also be individual investing for other reasons too. So you're trying to save up to buy for a home. But I want you to be thoughtful about that, and then also think about how from the financial industry, how they cater to those needs, and also from organizations' perspectives, how they invest, whether directly to try to increase their return on their assets, or if they have extra cash that they hold on hand, what is the acceptable investment? So it's a very important thing that I want you to understand, is that even if you're not directly related to the money, but it's so important to make sure that those are in charge of the money have very direct guidelines about what they're allowed to invest in. And typically those that are nonprofits have very strict guidelines, because they don't want to lose money behalf the organization. They're typically going to stay somewhere very safe and very liquid. Like I work at a metropolitan community college in Kansas City, so we basically invest in CDs and repurchase agreements and government debt, something that's very relatively safe. So, all right. So with the other chapter 2, you're going to get a little bit more understand the markets and transactions. You're going to understand the difference between money market, basically anything that matures in 1 year or less. They can be treasury bills, CDs, money market accounts, and then you look at the capital markets, which we typically think of anything that matures in longer than a year. It can be bonds, but again, stocks don't mature, but we consider them part of the capital markets. And you look at the idea of the initial public offering, the road shows, how there's flotation cost associated with raising either bonds or stock, but it's a way for especially larger companies to go out and get capital, meaning money to help them finance their business. But you're going to look at the different exchanges, the New York Stock Exchange, dealer markets, electronic markets, uh, also derivative exchanges, like you think about in Chicago, Philadelphia. You'll look at the different concepts of what constitutes a bull market, a bear market, and the importance of the globalization of securities. One of the things I also want to point out is that the availability of information out there has changed so much. When I was getting into finance in the late 80s and early 90s, I worked for a stockbroker with my senior year in college. But pretty much everybody went through a stockbroker. There was no internet, and that is if you had money. So, but now you all have so much information about availability of markets. It's still how do you interpret that information, apply to your investment strategy, but it is so much easier today. Just like open up a Fidelity account and boom, you can start investing on your own. So, of course, there are risks associated with that without having some knowledge, and that's one of the purposes of this course. So, and then finally, you're going to get a little bit in the wrap up of the securities laws. We put these laws in place to help stabilize the markets. We learned a lot of lessons again from the subprime crisis to try to help stabilize markets, but there's always going to be financial crises that occur, and we'll put in additional corrections. But overall, we want the markets to be healthy in the sense that everybody believes that it is not positioned to be favorable to just one particular group of investors or be rigged. So that's why the government is going to step in to make sure that the markets are efficient. So, and you're going to look a little bit more about some terminology. Long term, meaning that you're betting that the price goes up. Short, that you're betting that the price goes down. And there's some derivatives that you can do to help increase your potential gains, but there's also risk associated with those. And then finally, you're going to learn about margin trading. That is the ability to buy stocks with maybe not having all the funds available, so you go out and borrow, but the purpose is to try to magnify your returns. But if the stock does not go in your direction, it can actually magnify your losses too. So again, there are risks associated with that. So anyway, I hope everybody has a great week. And again, if you do have any questions, do reach out to me. But I look forward to talking to you online. Take care and have a great week.